So I figured for lunchtime, to keep you all alert, awake, and engaged, this would be a perfect combination. So, Julie.
This is on.
Yeah.
Now, yes, you can hear me. I'll try to be irreverent, unless there's someone here I should revere.
No.
Okay.
I want to start. I don't know if any of you read the New York Times article this morning. Why it's so hard to invest your money with a social conscience. Did anyone else read that? Julie, how would you answer that?
This is an article that was written by a financial writer who is unacquainted with the field of sustainable or impact investing. Therefore, sees it as some exotic beast that you have to trap very carefully, and that might lash out and hit you at some point. It's not hard to do sustainable investing. It's not difficult to find companies that are sustainable. It's not hard to identify companies that are cruising on thin ice. This can all be done. And if you run a fund, as I do, which is, we actually have about 10 of them, funds, you're going to do due diligence on every company in the fund anyway, right? So the idea of avoiding gun stocks, if that's what you want to do, or the idea of investing in companies that are going to prosper in the low carbon transition, that is something that you do just as you research anything else with the company. What are its financials? How durable is its EBITDA? Whatever you're looking for, this is just another piece of information or a set of information that you look for in the company. It's not hard at all. So that was written by somebody who didn't know how to do it.
Do you agree that there is a tidal wave of impact investing?
Yeah, there's certainly more interest in it. We're seeing the assets grow. They've grown faster than assets in pretty much any other class for several years now. And this is actually true not just here. It's obviously in the figures that are in that article and the ones that you put out before were from America, where it's like 8 or 9 trillion at this point. And that includes funds that do what I call sustainability light. They'll avoid a certain class of stocks or a certain model or something. But what we call full integration of sustainability is something that's the fastest growing category, and that's growing everywhere. Europe, North America, and Asia. In fact, I think it's growing really fast in Asia from a small base, which is why it's growing so fast. So yeah, it's something that millennials are most interested in. So while not all the millennials have all the money they're ever going to have now, if this is what they're interested in doing, you can be sure they're probably going to drive things more that way. That's certainly the way the industry is positioning itself for that driver.
How do you define this category of sustainable investment?
There are a million ways to define it. What
You're going to have to hold that up
closer. This is millions of years ago, back when people were hunting mammoths. I used to work for Congress, and I had to testify before them several times. And every single transcript, every single time I testified was, Dr. Gorte, would you please slow down and speak up? So if that's what you want me to do, just go like this, and I will do that. Okay, I will. Is that better? I'm sorry. Okay. How do I define sustainable investing? There is a term, I don't know if you've heard it, it's called full integration of ESG. ESG means environmental, social, and governance factors. Full integration means that you use those factors, that data, alongside the financial information that you would collect on any investment that you would be looking at as sort of a full picture of a potential investment in portfolio construction and in portfolio management. So you may decide that there's a company that's a little iffy based on its financials, and so you'll underweight the position a little bit, or you'll trim the position a little bit. You can also do that because you don't particularly like something that it's just done from an ESG perspective. For example, like last week or something, it was, what was the app? Can't remember. One of the apps that had put out an ad that asked whether people would rather slap Rihanna or hit her partner. And she hated that. She then came out on a different app, and my favorite app. But even if you were, that was wrong. You have made my past as a victim of sexual violence into a joke. And that company's stock went down 5% the next day. I mean, because people were deserting it. So there is and if you look among the large cap companies, the S&P 500, 84% of their market cap consists of intangibles, which makes them very vulnerable to reputational damage. There's no underpinning of bricks and mortar that will prop up value. So you can lose a lot of your value really fast if you run into some kind of crisis, and that is just as likely to happen environmentally or socially or because of your product. Talk about Uber, for example. You can lose a lot of value really fast. So for me, this is just a way of doing something that I learned in finance, is the efficient market hypothesis, incorporating all the sources of information I can get my hands on in that company in order to invest and in order to manage the size of that position in a portfolio.
Before I ask another question, I'd like to know how many of you are already impact investors? Quite a few. How many of you have been impact investors for 5 years or more? Again, quite a few. Julie, what do you think the trends are in impact investing? That's a general question. It's really hard to answer.
And I'm going to do, there was a quote at some point that he flung himself from the room, flung himself on his horse, and rode madly off in all directions. I mean, that's the kind of question I can answer in 10,000 different ways. Sometimes the trends are very micro. So the Stoneman Douglas High School shooting, you saw a lot of press and a lot of activity among some investors, BlackRock, for example, saying we're going to engage more with companies that either make guns or sell guns or whose financial products finance the transactions. And there have been several asks in that regard. I mean, there was I think again, a New York Times article right afterwards, like 2 days afterwards, that said, okay, Square and Apple are already limiting the use or restricting the use of payments using their products for assault weapons, which is one thing a financial company whose product can be used to finance transactions can do. So sometimes the trends are really micro, like that. Sometimes they react to world events. In the longer term, when I think about the trends in sustainable investing, I think about what are the durable drivers of value. And to me, the durable drivers of value in this world, okay, right now you ask any portfolio manager and they're going to say, well, the baby boom's aging, they're going to need pharmaceuticals, there's going to be a boom in healthcare. Cool, all right, that's a driver. But that's a demographic driver. You can always look there for financial drivers. Another place you can always look for drivers is like climate change. There is going to be a ton of investment needed to cope with climate change, both adaptation and mitigation. Both, we're going to have to do both. We have to avoid the unmanageable and we have to manage the unavoidable. So if we've got 2 degrees of warming ahead of us, that means there's going to be a lot of places, thank goodness this is not one of them, where the sea level is rising. And instead of it, you getting floods when there's a storm, you get a flood every high tide. Where I just came from, New Hampshire, I lived there until last summer when I moved back to Colorado. It was flooding at first of all, it started flooding at every king tide. Now it floods at every high tide. In a town with a nuclear plant in it. Last time there was a flood at a nuclear plant, we had a major crisis. So that, I think, is a durable driver of value. It's also another durable driver of value is equality. There's more and more interest, including in the mainstream investment world, in diversity. Not because women are better, women are not broken, men are not evil. Diversity makes for better decision making. So a group of all women 30-year-olds on a board would be just as bad as a group of all men 60-year-olds on a board. So what you need is diverse perspectives around the table. You're less subject to groupthink. That is a durable driver of value. You just saw this year, BlackRock and State Street are starting to vote against all male boards. BlackRock also announced that it would start voting against boards that only had one woman on them because they were tokenism. So that's going to be something you have to take account of if you're a board. There are a lot of boards now thinking about sexual because that can be a really huge value loser. So again, we look at sustainability as a durable driver of value in many places. We have to undergo a low carbon transition. We have to, in India, they have to clean up the air and the water, or it's not going to be a place where anybody wants to keep their money. Same in China. So those are the things, that's what I think of sustainable investing as being. Then this, the kind of thing we're talking about here, angel financing, venture financing, unicorns, things like that, that's where a lot of the ideas come from. We can't afford to give up on the rest of the world, but I think where a lot of the really good ideas for sustainability, I just heard, because I listened to a couple pitches here, 3 of them, that's where those things come from a lot of the times. You don't see this stuff bubbling up in the mega firms, but you see them buying up these ideas because they're so sustainable. That's why Unilever bought Ben & Jerry's. That's why Stonyfield was bought by Danone, because they had something to teach those great big multinational companies.
I don't know if Dave planned this, but the pitches we did listen to right before Julie and I took the stage were energy and fuel efficiency in automobiles, water safety, and personal safety. And I was telling Julie that Rockies Venture Club, in its portfolio of 30+ companies, probably 40% of those are what we would define as impact ventures. We didn't explicitly seek impact in those ventures, but I'm wondering if it relates to both the trends sort of nationally and internationally, as well as possibly a Colorado factor.
Interesting question. You certainly see a lot of it internationally, well, and nationally for that matter. I mean, last year, the year before that, we had an election, and a lot of people thought that the prospects for sustainability and for sustainable investing were dimmer because of it. It's been anything but. I think we're seeing an age in which people companies expect the private sector to deliver on some of the transitions we need to make as a society, on the promises of sustainability. Their policy isn't only made in Washington, D.C. So we have a president who decided to pull us out of the Paris Accord, decided to get rid of the Clean Power Plan. Neither one of them is actually done yet, but they've promised to do both. That America is, however, still on track to meet its nationally defined contribution to the Paris Accords, or the Paris Agreement, I'm sorry. Whether we pull out of it or not, there are a lot of states and a lot of cities and a lot of companies that have put together science-based targets, which means having their emissions by 2030 and taking the numbers that will come to me as soon as I leave this room and get in front of my computer. But you have to basically get yourself to net zero emissions by 2050 in order to avoid 2 degrees of warming, more than 2 degrees of warming. That's pretty challenging. But there are a lot of companies that have actually made that pledge. I mean, if you look at Silicon Valley, you look at Oracle and Apple and lots of Amazon, they've all committed to 100% renewable power, which is a big deal if anybody's using your stuff for currency, because that mining takes a lot of electricity. What was the question? I talked myself into a painted corner, I guess.
If we look at the range of options for impact investors, from the very large funds on one end, down to what we're typically involved in, which are venture startups, where do you see the biggest gap in the products that are available for investors that are interested in impact?
So I think there's more and more opportunities at this end of the market, the impact angel financing, venture financing. I'm on the investment committee for a major philanthropic fund. It's called the Wallace Global Fund. It has about $150 million endowment. And they took the whole thing sustainable and fossil-free, but they've also allocated a portion of it to impact investments, specifically small, non-publicly traded new ideas. And I think there's a growing appetite for that among a lot of institutional investors, including philanthropic foundations. I mean, they can't afford to do all of it or do it all for their whole endowment because of the liquidity. But for it makes a lot of sense. And I think for mutual fund investors, there's a, sort of an increasing panoply of choices, but those choices are mostly in sort of standard categories: large cap domestic, large cap international, mid cap, small cap, value, growth, you name it. There's a lot of themed funds, women's funds and environmental funds and clean carbon or low carbon funds and so forth. There's not a lot in the alternative investments arena. So if you're talking hedge, long, short funds, there's not as much there.
I'd like to hear some questions from the audience. Trish. Might want to repeat the question.
Yeah, so if I heard you correctly, you wanted examples of companies that, or sustainable companies that had done really well for a portfolio or that had exited and done really well. I'm not as familiar with the exit strategy because this is, again, in mutual funds, we have to mark to market every day, so we don't do anything that's private equity. So I'm not as familiar with it. When I look at some of the, so I'll just give you a sort of a macro example and then I'll deep dive down to some of the companies. We introduced a women's index in 2014. And so we pick companies for the women's index. We look at MSCI World, which is about 1,500 companies, global, developed markets. And we have an algorithm that scores companies based on the percentage of women on the board, the percentage of women in executive management, whether they have a woman CEO or CFO, and I can give you academic evidence for all 4 of those that shows that is actually can contribute to financial outperformance, and then whether they've adopted and implemented the women's empowerment principles. And then we have an index of about 400 companies. I say about because there's always ties, and you don't want to just make a choice based on alphabetical order. And that index, since its inception, that was the only factor we based it on, right? So it was just MSCI World and then the women's algorithm. And that has since inception, and it has also, one of the emergent properties of that is lower risk, higher quality, right? So we get a higher dividend payout ratio, lower volatility, lower risk, so lower beta. So that's a kind of a macro example. That doesn't mean that any company you pick is necessarily to behave like that if they have half women on the board. When it comes to specific companies, you kind of have to dive down and look more at the specifics of that company. But I remember I saw it in the Waterlizer pitch that was just here. The guy that had so one of the companies we invested in for a long time because we picked it for our environmental fund based on its water technology was Xylem. And that was one of his exit possibilities, as I recall. So right now is a time when there's growing consciousness of water as a limitation on growth. You look at South Africa and what's happening to Cape Town and day zero when that city is not going to be able to meet the needs of customers anymore. So any company that can deliver better water management in terms of more efficient use of water or in situ treatment and reuse or something can be a really winning idea in where that's more likely to be the case. And that's actually more likely to be the case in Denver in the future too. All the climate models show the Intermountain region getting drier, as well as California. So that wonderful drought that you all heard about for 10 years in California, it's coming back. There's that. So the other nice thing about water, and that's when you look at the individual company, you get these little aha moments that come out at you. Water is one of the best energy ideas there is. If you can do in situ treatment of water, if you can process water where it's used and reuse it where it is already being used, then you avoid transporting it. Transporting water weighs 9 pounds a gallon. It takes a shitload of energy to move it around. So if you look at the most energy intensive sector on the planet is not energy, it's utilities because of that. And it's not just electric utilities. Electric utilities are mostly burning fossil fuels, and so they're very energy intensive, but water utilities are almost as energy intensive because of exactly that, because they have to move a lot of water around. So again, that's one of the sort of the bubble up areas where we're seeing a lot of, water ideas can solve multiple problems. Did I answer your question?
or we got to start at it. We'll work on it. Another question. Yes, Emily.
Oh God, what keeps me up at night? One of the reasons that we look for information on how companies treat their workers, how they protect human rights in the supply chain, how they protect the environment, how much energy they use, what kind of energy, is because those give us their safety. Those give us just an early warning of risks that the market is not yet pricing adequately, right? So we're doing this to do what all investors do. You want to skate to where the puck is going to be. So you want to forecast which companies are going to do better and worse. We think that more sustainable companies are going to give us fewer bad surprises. So anytime a new problem comes up that is a destroyer of value, sexual harassment is the issue du jour. You want to say, all right, well, how do I see that coming? And frankly, for that one, I can't. There's nothing I can. So every company, including Uber, including Weinstein, said, we're an EEO company. You know why? Because it's the law. You have to obey that in the US. And they all have diversity training and harassment training. That is not enough to avoid a culture of harassment. But that can ruin value. It had a major impact on Uber, had a major impact on Weinstein. And there could be a lot of others where it's now being, you look at the Harvard Law School Forum on Corporate Governance, and there have been like 5 articles on the fact that boards now really need to oversee sexual harassment risk. Boards, right? So these are the fiduciaries. They need to oversee sexual harassment. That's what keeps me up at night. How can I see this coming? I could see BP coming. BP had a shitty safety record. They killed more people in 2005 than they did in 2010 by blowing up a plant in Texas City. And then they kept getting OSHA fines that were orders of magnitude higher than the typical OSHA fine. You could see that thing coming a mile away if you were looking at safety records and you knew BP. I can't see this coming. Sexual harassment is the one that I can't see coming. So that's what gives me my oh God moments in the middle of the night. What if?
Another question? Well, I've got a question for Julie. One of the myths, at least I think it's a myth, about impact investing, especially if you're thinking about the smaller end, the angel or venture end, is that you do have to compromise financial performance in order to achieve sustainable goals. And when I was talking with Julie, she used the term intellectual vampirism. So could you share your insights about that?
Why I became a vampire slayer. So the idea that in order to invest sustainably, you are going to give up returns. You're not going to get competitive returns. It's been around forever. It is something that there are still a lot of people on Wall Street who think that. You can always find some anecdote to prove it if that's what you want to do. You can find some sustainable fund that performed that year. But if you look at it overall, that's just not true. There was a recent article from South Pole Carbon and CSSP that looked at 11 low carbon indexes. 10 of them outperformed their benchmark indexes over the past 5 years. I mean, that's to make that one into a story of underperformance. I've been keeping a database of the studies that actually have a replicable methodology. So it's not just somebody going, look, I outperformed. It's somebody that actually looked at funds, looked at companies, compared them with, an appropriate control group and said, all right, is more sustainability doing well financially or not? And I have about 500 of them now, all of which show that there is no penalty to sustainability in investing, and it's often a source of outperformance because it gives you an extra insight into risk in particular. I've been calling that an intellectual vampire because that little vampire gets up every night and sucks somebody's IQ dry. Because there's always another investor who thinks, or an advisor who thinks that that's true and will pass that along to someone else. And so I've spent a lot of time driving spears into that vampire. Spears, stakes. What are you driving to vampire? Stakes.
Stake in the heart, yeah. We'll just start calling it fake news.
Yeah.
Yes.
So you've spoken some about sustainable and kind of the characteristic stuff, but as a company that never really considered itself an impact company, but in learning about what an impact company is, I guess I am, is there an easier way to like measure, or what are the metrics that you utilize to say these people just care and these people are sustainable, and what's the difference?
Oh, you have unleashed a can of worms, my friend. That's my favorite mixed metaphor. What are the metrics? So the basic metrics are what's your impact on the environment? What's your impact on your workforce? What's the impact on your value chain? And how are you governed? So there are 4 buckets in which you can shove metrics. If you're a software company, your impact on the environment is probably negligible. It's not material. You can probably look past it. If it isn't, doesn't mean you should overlook it necessarily, but it's not necessarily going to be job 1, right? So any company can care about diversity. Any company can, care about any issue, but is it material to your performance and your investors? How bad? What's your black swan? Like if you're a water company, if you're a water utility, the black swan is Flint, right? That's like the worst thing that can happen. Your value is going to go, you got one foot on the banana peel and the other in the grave, right? So you think about that and it's like, what could cause that to happen? Need to look at, what do I need to manage in order to keep this risk from happening? Most companies discover what that is by actually having it happen. And then they develop really good policies about it. So that is why you see large cap companies will report on all of these things. You want to see good sustainability policy? Look at Intel's website, right? Look at GE. They've been through it. They know how bad things can get because they've made them happen. Right? For small companies, you get a leg up if you do that before you have to, right? So I don't know what kind of, you just pitched, didn't you? Did you? No, okay, sorry. I must be Mr. That's why I have glasses.
So the machine learning platform helps you buy from the highway.
Cool. Okay, so, all right, so what could be your black swan? Have you thought about it?
Yeah, well, associated with having an incredibly diverse workforce, or having our platform, we think it promotes diversity, but maybe it only identifies qualified white males.
So welcome to the world of Google, right? Yeah. So yeah, it's funny. I listened to, as I was coming in, somebody was talking about, you don't have to trust, of people, you can, trust code. Well, people write code, right? So you can embed a bias in code, in an algorithm. How do you avoid doing that? This is where diversity comes in handy. Who understands code? Make sure you've got a diverse group sitting around going, how can this possibly, could this be biased? And then you look at the, what went in, what came out. Is there any way to interpret this as being biased? Just keep kicking the tires. It sounds like you've thought about it quite a lot. So the other thing, obviously, anytime you're in software, this kind of like hacking, cybersecurity, that's huge, right? Could anybody get into your system and steal something they're not entitled to? Welcome to Facebook. Yeah.
Trish. Repeat the question.
The question was, what's the difference between sustainable investing and slow money investing? And frankly, honestly, I don't know that there is one. I'm not as familiar with slow money investing, at least not from a firsthand standpoint. We call ourselves long-term investors, and most of the sustainable investment specialists do as well, because we're never going to shoot the lights out on the upside. We're never going to be the 35%, in 1 year, and then, sort of first quintile the next year. But the idea is that the factors that we are looking at in investing, most of the time when you're looking at financials, you're looking at what could the impact of this be in the next quarter, in the next half year, in the next year. 3 years is the long term. What can I say? This makes that kind of myopia is endemic on Wall Street. What we're looking at are factors that I don't call short-term or long-term, we call them indeterminate term. When is climate change going to impact a company? Could be yesterday. For a lot of firms in Houston, it was yesterday. In the last 2 years, there were over almost 900 climate-related, damages-related lawsuits filed in the United States. That's not a litigation risk. So a lot of people look at sustainable investing and say, okay, you're looking at long-term factors, but anything can happen in the short term, so we have to still pay attention to short term. Yes, we do. But what characterizes both sustainable investing and slow money investing to me is that we're not thinking short-term, long-term, we're thinking about value drivers, right? And that can happen in any term. Just because the ocean is probably going to be 2 feet higher in a century doesn't mean it's going to all happen 100 years from now. It's going to happen over the next 100 years. And during storms, you will really notice it. And you can't predict those, right? So I think with slow money, I think the idea is that you're thinking about things that aren't necessarily just going to impinge on you in the next quarter and pricing those.
Yes, Jolene.
Yeah, that's typical. Yes. A lot of times companies will say, I don't know where to look. Or when I look in the normal places, I don't find any qualified women. It's kind of like, well, if your normal place is the locker room at Augusta National, no, you're not going to find any. But so you may need to diversify where you look for qualified board members. There's also, an idea that in order to get a board member, there needs to be a sitting CEO. Most board members are not sitting CEOs. Don't limit your scope of view to what, the caricatures, I guess, of the board. Look at universities. One of the best things that ever happened to Nike was when they put Jill Kerr-Conway on the board. She was a professor at the University of Oregon, still is as far as I know. So you can look for leadership under many different lampposts. You don't just have to look for one. Another thing that we do, yes, we do talk to companies. We vote against the entire board slate for every company we own that has either no women on the board or only one. And then we send them a letter afterwards and tell them why. And there have been about, a couple dozen over the years that we've been doing that have actually called us or written to us and said, okay, well, what should we do? I mean, how should we go about looking? There is a diverse director database out there. It was started by CalPERS. There are other resources that you can look into. I'm sure we know what they are. And just make sure that people understand what they are. And if you go against those all-male boards, eventually those boards do get the message. They may not want to. But now with BlackRock and State Street and even, Vanguard talking about voting against those boards, you can't hide anymore because your board members will actually, lose in some cases.
I just want to make a remark for those of you in the audience. Jolene is chair of an organization, the Women's Leadership Foundation, whose focus is on increasing the number of women on boards, especially corporate public boards. So any of you in the audience who have ever served on a public board, we'd love to meet you and get to know you and have you be a mentor for some of the women who are in our program to take seats on corporate public boards. I want to talk about what I think is the elephant in the room, and I didn't bring it up earlier because it tends to consume the room, and that's how do you measure impact?
I wish I had better ways of measuring impact. Everybody and their dog is going to tell you that. There are some impacts that are easy to measure. You can measure emissions avoided. If you have a baseline of your either air emissions or greenhouse gas emissions, and you either buy offsets or you have reduced your emissions through some step that you have taken, or you've reduced your solid waste stream or whatever, those things are easy to measure. A lot of times the environmental ones are, they're inherently quantitative. Not difficult to measure, you just have to want to do it and then keep records. For things like, if you look at the Sustainable Development Goals, everybody know what I'm talking about? UN SDGs? Of 17 goals, there are some like reducing poverty. How do I measure that? You know, or assuring that there's an end to hunger. Just because you make lollipops doesn't mean that you're ending world hunger, right? And you know, the sort of the SDG that's about health, I think it's SDG 2, improve everybody is kind of like, okay, well, every pharma company on the planet is going to say that they do that, and they do, some of them, most of them. If the only thing they're making is Botox, it might be a little bit dicey. Do they need that? Do they need that? Anyway, so the SDGs were put there in order to call attention to problems that weren't being solved by business as usual. So if your business is what it was, you know, before the SDGs were put in place, can you really claim that you're making a contribution? Those are the questions that are really kind of absorbing everybody in my world right now. And there are at least 10 groups that I know of that are putting together impact measurement schemes, all of which are probably going to be somewhat imperfect in the end. Right now, there aren't really good ones. So we do what we can by measuring the things we know how to measure and can report on, things like water use avoided, emissions avoided, offsets, stuff like that. We can measure diversity too, that's another thing. So my firm, for example, is pretty much almost all white, but it's the management of it is almost half female, which is unusual for an investment firm. So, you know, we feel like, all right, so we've made some progress, you know, but so your question, you want to find black people in New Hampshire? Good luck with that. My firm actually is in New Hampshire, by the way. I'm just the kind of the Colorado outpost of it.
Any insights from those of you in the audience about measuring impact?
Yeah, I just wanted to ask you, in terms of measuring your impact, do you do it on an individual basis? So you might have a number of companies in your portfolio that are environmental, but not all will have, like you said, you know, emissions that they can track. So I'm just curious about the approach of looking at impact on an individual basis within a company in your portfolio, rather than trying to tie one metric to a number of different companies. Does that make sense?
Yeah, that's actually often the way it's done, is that you can, like I can go through my portfolio, pick all the utilities out of it and measure all the water use and all the, you know, energy consumption and efficiency and renewables and all that stuff. That's easy. And so we often do it exactly that way. I think the contribution that you make when you do it that way, though, is you say, all right, I am going to measure the energy consumption of the water utilities. So it's not just looking at whatever the main business of that company is, what's the impact of that company? Then when you sort of move out into other sectors, you have to get a little bit more creative with it. It helps to have the framework of the SDGs to think about. So is this company doing something specific in order to alleviate poverty? So if it's a pharma company and if it has an access program for access to medicine in poor nations, then you can say, all right, that counts. That particular program counts. It's not necessarily every pill they make, you know, but they are doing something to go above and beyond just making a whole lot of money by making drugs, right? So yes, it's very much company by company. Sometimes it's even line of business by line of business, sorry.
If you're going to disagree, do it over the mic.
All right, so now I'm going to be permanently recorded. Everyone will go back to this and throw tomatoes at it. But I'm a retired executive at BP doing health, safety, and environment. So I took a bit of offense to your comment because I've seen the other side. I worked overseas. I didn't work in the US. The other flip side of BP is that sustainably changed Cairo, Egypt, in that we gave away seatbelts and lowered the safety risk in Cairo, as well as we implemented compressed natural gas as a transportation fuel, which significantly improved, well, it made an impact on the air quality. So there are two sides of every coin.
Absolutely.
So I guess what I would say is that the industry itself, yeah, it's got a pretty tough road to go down. But the company, I'd like to maybe have a beer with you or something and give you an alternative view. But my real point, the reason I want to bring up is that the easiest thing to do for impact or sustainability is to use categories such as gender or race. As we tried to promote people, gender and race, our problem was getting them not to think like white males. So we didn't add diversity by changing the gender or race. For example, I'm a Native American, but I think like a white male.
Yep.
So I don't add any diversity to that thought process.
Right. Well, in a sense, gender and race are proxies for diversity of perspective, because women do tend to have different experiences than men, but that doesn't mean they're necessarily not going to act just like the white males on the board. So yes, we count the things that we can count, knowing that they're imperfect proxies for what we're really after, which is diversity of perspective. Thank you for pointing that out. You're quite right. But, you know, short of getting inside every board member's head, there's no other way to do it. At least I don't know of any other way to do it. You can, I mean, one of the things that I used to love about the corporate library before it was acquired twice was that they were basing their governance ratings not on the sort of characteristics of the company, but on what happened in the boardroom. The problem is that's really hard to do because most of the, I mean, people can't even take notes and then take them out of boardrooms. They have to leave them in there because they're confidential. It's hard to make judgments on those things, but that would be perfect if we could. As to your point that there's never one story with BP, that's true of almost all companies. Yes, I laugh and point and dance around Uber and BP and, you know, several others, but BP has done a lot of good. When I was working in 1997 on the Kyoto Protocol, I was at EPA in the policy office. The company that we could always rely on to come and say, yeah, this is possible, and yes, we have to reduce emissions was BP. I thought of it as a white knight. You know, its problem wasn't environmental, its problem was safety. It's done a lot of good. It still does a lot of good. I think, you know, one of the sustainable investing that is eternal is that everybody and their dog is an armchair researcher. So they read the Wall Street Journal, they see a story about a company, they look at the portfolio and say, oh God, this company is in my portfolio. And then they write me a letter, if it's a portfolio, and say, which might as well be entitled, Dear Stupid, how could you possibly own this dreadful company? Companies are mixed bags. You know, you have to make a decision based on, you know, the balance of, you know, what you think its benefits and its drawbacks are. When the black swan events are something that you're always trying to avoid. That was why safety was such an issue with BP. But I appreciate your point. Thank you for making it. And I'm glad you're in the audience. And I'll take you up on that beer.
Barbara, we probably do one more.
Sorry? Oh, that's even better.
Barbara, we can do one more.
Wait, pardon me?
We can do one more.
One more. Then I'll ask Julie a last question. Hypothetically, if there were a group of, or an angel investor community that started an impact fund, what mechanisms work to get investors from foundations into that fund?
There are a number of forums now for institutional investors that I think are much more open to hearing about such ideas than. So if you go to a, say, oh God, what is it, the CII, the Council of Institutional Investors, it used to be that you had to do a side event on sustainability. That's now mainstream on the program. Confluence Philanthropy is a good place to talk to and to the foundations and endowments. That's just one. And so if you're interested, I can send you a sort of
A suggestion?
yes. I mean, I have several things in my mind. I don't have an actual list, but I could make one.
That would be great. Thank you. So let's give a round of applause.